What's up, guys? So FundedNext just introduced another new rule, I think for the 10th time this year. I mean, maybe I'm wrong, but the point is they've been coming up with many rules over the past few months. I think in the last 12 months, they've introduced a couple of changes, which in my opinion, most of those changes, to be fair, you can still trade with them and make money. I still trade with them. They're the company which I first got 6 figures with, first got my first 5 figures in payout in FundedNext, etc. So they're still a great firm, they still do payouts, but the truth is they have been really coming up with these new rules every time, and in my opinion, I find it a little bit hypocritical. As much as I have been fronting them and telling it's a good firm, it's still a good firm, to be fair. If you look at the PropFirms, top 3, etc., but they all point for me saying I find them, to be hypocritical is because they started as a firm which used to market themselves saying, they allow you to trade any style you want. They allow you to be free in your trading. They don't have all these unnecessary restrictions, which in my opinion was just probably part of their playbook in the prop firm business, because they started with all these, good conditions, no consistency rule, no stop loss rule. You're allowed to trade during the news. You can copy trade across your accounts. And then after about, I think, 1 or 2 years in business, when they were among the top 3 firms, I personally noticed they started to just change the rules slowly by slowly. And now when I saw these rules being introduced the other day, I was like, these guys probably have a playbook for just introducing rules, and they're sitting somewhere in the boardroom. They have a whole plan for the new rules which will be coming up, to just take out that freedom they had given you before. Because first off, they removed something called the copy trading rule. And for those who don't understand the copy trading rule, it was that if you have multiple accounts with them and they are funded, you cannot take the same trade across both accounts. Now, that may not look so bad, because you might argue, if I have 3 funded accounts, I can just take a trade on one account, wait for a payout, go to the other account. And that makes sense. But now this is the tricky part with the copy trading rule. If you have a funded account and a challenge account, you cannot take the same trade, which goes to say, if you have a challenge and a funded, each one must have a different probably trading strategy, or you must be taking different type of setups. And how practical is it for you as a trader to be having, let's say, 2 accounts and each one of them you trade different strategies? It's not a very easy thing. Getting an edge already in one strategy is a lot of work. So now imagine trying to get, an edge in 2 different strategies. For me, that rule affected me, because when the year started, I had 3 funded accounts in FundedNext, and I could no longer copy my trades across my funded accounts. Now, that wasn't the biggest deal. The biggest issue for me was I had a plan to get max allocated with FundedNext. I only needed to buy another 100k in FundedNext and I'd be max allocated. But guess what? If I buy that 100k, I cannot take the same trade to pass the challenge as the trades I'm taking in my funded. So that means I have to look for a new different trading strategy for me to pass the other 100k and get max allocated in FundedNext. And that way, from the beginning of the year, I didn't rush to take any new challenge from FundedNext, because now it means I can no longer take the same trades. For me, that copy trading rule, I just think it doesn't make sense. I think it would have been easier to just say you can't use a trade copy. That would have been enough. But this idea that if you have 2 accounts, each one of them must trade differently is just not realistic if you really, care about the traders. So now think of this. The only way right now I can get max allocated in FundedNext is either I have a different strategy for the new account I'll purchase, or I have to forfeit trading my current accounts, and if possible, I need to breach them so that I can now take 2 challenges, 2 big challenges at 200 and 100, and hopefully I pass all of them at the same time. But as long as you are funded, now I can assume if you have like a small 10k funded account, then you do some payout. Then you tell yourself, now that I've passed my first 10k in FundedNext and I've got like 5 payouts, it's time for me to scale up from a 10k to a 50 or 100k. Guess what? If you get that 100k, you can no longer get payouts from your funded if you are taking the same trades in the challenge. So you'll have to stop trading the funded and now focus on the challenge, or look for a completely different strategy which will be giving you different type of trades in the funded, which that's just not very, very practical. So from the copy trading rule, they introduced the news trading rule just a few months ago. The news trading rule was that now if you make your profit during the news, you'll only be given 40%. And that seemed quite fair, because to be honest, almost all prop firms out there don't even allow you to trade during the news, especially when you're funded. When you're funded during the news, for most of them, it's a breach, or most of them don't give you your profits at all. So they came up with that rule that once you hit your TP during the news window and you're funded, you only get 40% of your profits. The reason why I find these things hypocritical is because before, when they started, they were telling you that, unlike other firms, here you can trade any style. If you want to trade during the news, you trade, we have no restrictions. They also were saying, if you want to copy your trades, we do not care, copy your trades. Actually, when I got 6 figures last year, at some point I used to copy trade in my account. So if you do like a payout here, you can find you've made all your payouts in both accounts that you're funded. But I think when the year started, they felt like, no, these guys are making too much money by copy trading. So let's first of all remove the copy rule and let's make it worse. Even if you're trading manually, you can't take the same trade on both of your accounts. From the copy trading, news trading. From news trading, then they introduced the rule where initially you would get 15% profit share whenever you hit 5% profit on your account once you're funded. And I'm a beneficiary of this. I think in my 2 accounts, I've got paid this 975. 15%, but initially you only needed to do 5% when you were funded. But again, just a few months backwards, maybe 2 or 3 months, they moved it from 5% to 10%. So again, they probably figured out we are paying out too much people with this 15% profit share. Many people are hitting the 5%. So you know what? Let's make it a bit harder. And the truth is, many people will never hit 10% on their single funded account. But again, you might argue, that is not the goal of you getting funded. As long as you're funded, it's good. But I'm just trying to pinpoint to you and show you the playbook of these PropFirms. Then yesterday or 2 days ago, they've come up with another rule, which now limits you. You can no longer have 3% maximum risk at a time. Now, it's not hard for you to trade with this rule. To be fair, if you're a trader who's consistent, you can easily risk anything below 3% and still be consistent. So I'm not saying that this is the worst rule out there. I'm just showing you a pattern here that if you look at most of these PropFirms, and I made this post on my Instagram story, I think the other day, when they first come in, the rules are so good and they look friendly and they tell you we care about the trader. And the goal of this is just to get you lured. Once these firms have been operating for 1 or 2 years and they've got like a huge market share, I mean, truth be told, by the time FundedNext was introducing that first change in the rule, I think about 12 months ago, the copy trading rule, probably they were among the top 3 firms in the industry. Right now, I cannot think of any top 3 firms without putting in FundedNext. Top 3, top 4, give or take, you understand? So they knew very well that at the point that they are right now, they control a huge market share. They're doing millions of dollars of payouts. So they now start to make that trading a little bit difficult, because in the early stages, if they had come up with all these rules, many people would say, you know what, let me first go to FTMO, because FTMO maybe allows me to copy trade. Maybe in FTMO, I can take my swing account and I'll still trade during the news, and there won't be any 40% restriction, or let me try a different PropFirm which doesn't have all these rules. But now that they've got a huge market share, they slowly start to, introduce these new rules to make your trading not the easiest. So now let's look at this 3% rule and how it's going to affect your trading. I believe Funding Pips also has a 3% rule, but from what I've seen, the rule on Funding Pips is quite different. This one looks more tricky. And just before you look at it, if you're looking to, get your PropFirm challenge and you're not sure what company to go for, feel free to check out PropFirm Merge for you to do due diligence and comparison across multiple firms in the industry, see their ratings, see the platforms that they offer, whether they're available in your country or not. Most importantly, you can read through all the important rules there. Before buying a challenge, you want to make sure you understand all the rules so that you don't get yourself in the wrong side. And PropFirm Merge allows you to do all this filter here by a simple click of a button. Whenever you are trying to look for a firm on a budget, if that's what you want, simply come here under the offers and you'll find the best discounts available in the industry using the code that you can use. So I do have the links in the video description. That being said, back to our analysis. So this is the 3% risk in FundedNext. It starts by saying FundedNext recommends using 3% at a time. Yeah, when they say recommend, again, it looks like very vague language. It's like, I feel these companies should just be direct. They should tell you, we require you to use 3% at a time, not telling you we recommend, because recommend looks as if it's like an open, kind of rule, like you can decide whether you want to do it or not. So recommend is not the language PropFirm should be using. This is how many traders get banned, because you find yourself you are denied a payout because a firm told you we recommend this, but when you don't do it, they ban you and they tell you it's written in our rules, but they put it in a way as if it's not necessarily a hard breach or it's not necessarily a required rule, but the more you try to understand it, it is just indirectly a requirement. So 3% risk at a time if there is no stop loss. Now, risk in this case refers to the maximum potential loss based on your stop loss placement. So if you use a lot size calculator and you put a stop loss which is more than 3%, that would be, a breach of this rule. Now, this is what makes it more strict. If there is no stop loss under 3 minutes, the trade will be considered 100% risk. So someone like me, I usually open my trades and, sometimes I can linger around a little bit before I put my stop loss. So it just means I have to adjust and make sure within at least 3 minutes, which to be fair, 3 minutes is quite a good time window, but yeah, you just need to be careful. You can't afford to get any distraction, because I can imagine if you are putting your trade and you're still trying to set your stop loss and you just get distracted for 2 or 3 minutes, they'll consider that 100% risk and you'll have already breached this for the first time. Now, probably you're asking yourself, what happens if I breach this for the first time? What if that 3-minute window happens and I've not placed my stop loss yet? Or what if I use a risk which is higher than 3%? And for context, let me just add this for those of you who might not know. If a company tells you to risk 3%, don't go and calculate 3%, because there is spread, there is slippage. And guess what? Even if your trade gets slipped out with an extra 0.1%, this company will not, want to hear that. So I'll just tell you from my own experience. If they tell you risk 3%, make sure you're risking at least at most 2.7 or something, for you to just allow room for that spread, because you might risk exactly 3% and then because of spread or just slightly a late entry or some slippage, you end up closing with 3.04%. And these firms nowadays, they are very strict. They'll just tell you breached the 3% rule. So what if you are not able to meet these? Here comes the penalty. And of course, they'll tell you the rules are here to help you correct risky behaviors. It's okay. So here's the first violation. If you do the first violation, meaning you exceed the recommended, you see, again, it's recommended, but there is a violation. So it should just be a requirement, not a recommendation. If a trader exceeds the recommended 3% risk guideline for the first time, a reminder is issued, not just a reminder, but it comes along with a 50% deduction of the profit. So that is the penalty for the first mistake. Do it a second time, and the full profit generated from that trade will be deducted, or those trades, and an additional trading boundaries are recommended to support better discipline. This will include reducing the reliable risk to 1% at a time and limiting your margin use to 30%. So if you just breach this rule once, forget about 50% of the profits if you make any. Of course, it doesn't apply if you hit your loss. And for the second time, you repeat the same mistake, all your profits will go, and now your maximum risk at a time will be 1%. There's something I'm trying to understand with this rule, which I think, based on their grammar, it is clear. They're talking about 1% at a time. They're not talking about 1% per trade, because those are two different things. 1% at a time means if I have 4 positions running, all of them combined should not be more than 1% risk, meaning I'm risking probably 0.2% a trade. Same thing with 3% at a time. They're talking about 3% risk at a time, not 3% per trade. Now, Funding Pips has a similar rule on 3% risk, if I'm not wrong. Let me just try getting that right now. Funding Pips, 3% rule, and you're going to see the difference. The difference is simple. For Funding Pips, there are 3% rule states that no single trade should lose. See the difference? No single trade. The other ones are saying 3% at a time. So 3% at a time, unless they can clarify this for me, looks like your accumulative position. So if I have 3 trades running, if you're a trader who gets 3 positions at a time, don't try risking 1% across all of them, because that means you'll be fully utilizing the 3%. If one of them just closes with some slippage, you'll have violated this rule for FundedNext. But for Funding Pips, I think theirs makes more sense. To be honest, for Funding Pips, I don't even find this to be a restriction, because for them, they say 3%, but it is no single trade loss. Also, if you split the single trade into smaller positions, the combined losses, this still makes perfect sense. Like for them, it's just simple. That single position you've opened, let's say you're taking a buy on EURUSD. If you take 2 or 3 buys on EURUSD, as long as it's the same position to the same direction, they shouldn't close at a cumulative of 3%. But these other ones are just saying at a time. At a time means I could be trading 3 different markets, and all of them combined should not, lose more than 3%. And I just find it to be more restricting, but again, you can still trade with that very, very well and survive. I personally don't even risk 3% at a time, so I don't think it will affect me that much. I'm just, pinpointing all these things and calling it out as it is. So I had not finished telling you about the violations and the penalties you'll get for breaching their recommendations. You understand? So here's the third violation. Now they want to coach and improve you. And if you do this for the third time, you will be moved to something called a disciplined trader program. Hey, So now let's go to the disciplined trader program. Here it is. I've just opened a new tab. The disciplined trader program, now you are a trader who has violated the 3% rule at least twice. And now the third time you do it again, this is what the disciplined program looks like. And again, of course, they will tell you that this is meant to rebuild, structure, to build you into a better trader, better person. That's what they'll tell you. So here they say the disciplined trader applies to you who has probably been identified as a high risk. And by high risk, in this case, it's simply someone who violated that thing at least 3 times. According to that, it's high risk. And this is what will happen if you are found in that category. Your maximum risk at a time will now be reduced to 1%. Again, not maximum risk per trade at a time. So meaning if you have 3 positions at a time and it's completely 3 different setups, 3 different trading instruments, you probably will have to use 0.2% risk across each one of them, so that assuming they all lose, you're not close to hitting the 1% at a time. There will be a mandatory stop loss. Every trade must include a predefined stop loss. Now, the other one is that your stop loss should be put within 3 minutes. This one is that your trade must open with a stop loss. Now that is just, in my opinion, that does not help any trader. Very many traders, especially unless you're a scalper who's trading the 1 minute time frame, very many traders, sometimes you see your setup and you're still probably doing the math of where you'll put your stop loss, etc. You're still trying to chase the execution because sometimes you delay to execute and you're still setting stop loss and the trade runs away, moves very fast. So for very many traders, including myself, I don't remember the last time I opened a trade with a stop loss. I always first click the buy button because also on the time frame I'm trading, the prices don't jump that fast. And I think within about 2 to 3 minutes is when I put my stop loss. But there is human error. Sometimes you might get distracted. Something might happen a little and you find the 3 minutes have ended and you're still, trying to put your stop loss when you're MT5, etc. So in this case, your trade must open with a stop loss, which I think if I get to such a point, I would just rather stop trading with that firm because this will just be very hectic. Considering we have many top firms in the industry like FTM, which have been here for years and they've never introduced such, what I consider just unfair rules. Your margin utilization will be 30% at a time. I think right now the margin utilization should be 60 or 70% at a time, so it will now be cut to probably half or less than half. News trading will be strictly prohibited for you. So at the moment, news trading is allowed, but you can get 40% of your profit. So in this case, you cannot trade during the news at all. So are you seeing how they are trying to make you change your strategy? So imagine if your strategy doesn't allow all these things. So you have to now force yourself to just adjust to follow the rules. Next, we have the leverage, which will remain unchanged, etc. And now this is the worst part. If you had an active account, there will be no allocation restriction. But if you are to purchase any new account after you have got into this disciplined program, whatever, you will experience the same limitations. So again, let's assume you got your first account, it was a 10K, you got funded, did one payout. And then after the first payout, you ended up doing this mistake like twice, and now you are in this disciplined trader program. So if you try to now tell yourself, I've now made some payout, let me scale from a 10K in FundedNext, now let me buy my first 100K in FundedNext. You will have to trade that 100K with these limitations of 1% risk at a time and all these, 30% margin, no news trading, including the challenge. So long story short, I don't see these rules to be very fit. I have not seen any other firm which does this. Maybe there are, but I think they're just going way overboard in my opinion. Now, if you thought your penalties are over, let me shock you further. Once you've been enrolled to this program, guys, the maximum allocation you can receive will be $50,000. You understand? So I was saying that you can decide to buy your next 100K. So let's even forget about that because you can't buy 100K. Your maximum allocation can be $50,000. And any purchase you decide to make over $50,000 will not be refunded. But the good news is that you can graduate from this disciplined trader program. So if you've been in discipline for a while and it's time for you to graduate, the good news is there's a way to get out, as you can see here. But how practical is it? You need to achieve a total profit of $50,000 for you to graduate. So this is what will allow you to now go back to trading with the normal rules. You need to make $50,000 payout. I think they're saying this knowing very well that even statistically, most traders don't even do a $10,000 payout. So how many traders achieve a $50,000 payout? And you also need to understand payouts are achieved, big payouts are achieved depending with the, account size. If I have a 200K, chances of achieving the $50,000 even with a 1% risk is possible over time. But if I have a 10K account, 50K, even 100K, chances of achieving a total profit of $50,000 on that account is not easy. So from the time you join the program, the day you'll hit $50,000 accumulative profit is when you will have qualified to now go back to trade with the normal rules. And then you have to complete 5 consecutive successful cycles from the same account. 5 consecutive successful, this is basically payout. Consecutive. So that means you have to make payouts for every the next 5 cycles consecutively. Not even random 5 cycles. Consecutive means a FundedNext payout cycle, like in a 2-step Stellar, is every 2 weeks. So you need to have a 2 weeks period 5 times, which on that account you are making payouts. And this is so unreal. Anyway, that is it for the new FundedNext rule changes. At the end of the day, I still trade with them. I still think if you can meet these rules and not breach the 3% and just look to get a big account and take few trades, you can make money. But I also just like keeping it real. And the truth is, most of these rules do not favor you as a trader. If I find myself in this disciplined trader program, I would just give up and look for another different prop firm, because there is no way you are, coming out of that. If they are telling you need to make $50,000, at the same time they're telling you your account can't be bigger than $50,000, and the only way you can make such big payouts is if you are having like a big 200k account, which you are probably even risking 2%. So if you trade with FundedNext, you want to be careful and watch out for these rules. And this video, I've talked more about FundedNext, but the truth is, this video is about prop firms in general. The reality is, if you've been trading with these firms, I made this same post on my Instagram story. You need to understand that these firms' first priority is to be profitable. And I said this, while you are struggling to be profitable in the market, the prop firm is also struggling to be profitable in business. Both of you cannot coexist in this case. One of you must have tough conditions for the other ones to make money. If prop firms allow you to have smooth conditions, most of you will make a lot of money. FundedNext, I don't know, in the previous month, paid out about $10 million. A year backwards, they were celebrating paying like $1 million a month to be a big thing. 1 year later, they are paying out $10 million in a month. So clearly, they've got to a point where they are doing huge numbers. So they have to reconsider their structure. They have to look at their business and sit in a boardroom and ask themselves, if we continue giving people 15% profit share after 5%, and now we have 100,000 traders, how sustainable is it for a business? So the model maybe suited them when they were still a small firm, but it doesn't suit them anymore. They look at news trading. You guys are, trading gold during the news, and you probably are over leveraging and making $50,000 in one payout. So they look at it, and now they have 100,000 traders, 500,000 traders maybe in their database, and they're like, is this really sustainable? So they have to come up with rules which, favor their company, and of course makes it more tough for you. So typical platform playbook, which I want you to understand, and that's why I have mentioned many times that today I might tell you this is the best farm, but always have it at the back of your mind that things change so fast. A farm which was considered the best farm 2 years ago might not be considered the best farm right now because of 2 or 3 different things. One farm which might be considered good for me might not be good for you. That's why you want to do your due diligence. I might still trade very well with this 3% rule. I still think I will be able to trade well with this 3% rule. Someone else might not. I might be able to trade well with the news trading restriction. Someone else might not. So you just need to understand that with these prop firms, at the end of the day, it's a man industry. All you can do is go for the farm which you think suits your rules. It doesn't matter even if I tell you I recommend FundedNext, I always give a disclaimer. Still go and read the rules. If it doesn't suit you, I cannot coerce you into buying any prop firm selling that doesn't suit you. Go for the farm that suits you, and then have this risk factor in your mind. Just understand that it's a risk you're taking. Like, the best farms have still shut down. We've still seen farms like the Funded Trader going down, True Forex Fund, Funded Engineer. When they were at their peak, they still, went down because of 1 or 2 things. So just learn a tough lesson that these farms, anything can happen. That's why you can't treat them as if you're trading a hedge fund, because this is not a hedge fund. This is not your personal capital. And these firms don't care about you primarily, even though they might tell you at the end of the day. So you just go for that good firm, follow the rules, do your payouts, reinvest in other things, reinvest in your personal capital, for as long as these firms exist. If you read any firm's rules and you think it doesn't look nice, even if I told you I did 20 payouts with them, by all means, don't go for that firm. And also just understand that any firm can go down, any firm can change their rules. Even the best farms, even be it FTMO. I've said this many times. Even whenever I made videos with FundedNext, I still get people, saying, hey, me I got denied a payout with FundedNext. Same way, me I got banned trading with Alpha Capital. My friend Ken from Financial Lab has done, I don't know how many $100,000 of payouts in Alpha Capital consistently. The same time I was getting banned wrongfully. So what you come to learn is that we'll just have different outcomes with these firms. You just try to go for the top firms that are making sense and diversify, because this firm might give you a payout, the other may not give you a payout. And that being said, also invest money you are comfortable with. Don't be buying top firms with your do or die money, your last savings in your bank account. Don't be leaving your job because you're trading a 100K account. That's just not enough unless you have other income sources. The mere fact that you pass your first 100K should not be a reason for you to, quit your job or quit school, because that account might go tomorrow and you'll have nothing to do. That account might go into drawdown for 4 months and you won't be able to make any money from it. Or FundedNext might just send you to their disciplined trader program and you might never recover. I think over time, the firm that has seen has been more consistent probably is just FTMO. I now understand why over time FTMO will still remain the best company, regardless of the trading conditions. You might argue maybe they have, bigger spread in some currencies, but if you're just to look in terms of sustainability, they're the firm which has been so slow to, introduce all these new rules which limit you every day, apart from their 1% risk. And also theirs is 1% risk per trade, and you also get that after a few warnings. And to be fair, I have no issue with 1% risk a trade if I'm funded. You understand? Because most of them don't have a problem in the challenge. It's only when you're funded. If I'm funded 100K and you do 1% risk, a 3 or 4R still gives you $4,000. If you have a 200K same, FTMO has a max allocation of $400,000. Even if they limit you to 1% risk a trade and your max allocated, you're risking $4,000 setup to make $12,000 a setup. You have a month where you get 2-3 TPs. You've still done good payouts. So for me, I don't see that as a problem. And apart from that, most of their rules have been very consistent. But these other firms, I think every other, quarterly or every other 6 months, especially because they are becoming big firms, but they're barely 3 years old in the industry. So now they have to come up with adjustments. But FTMO has been here for 10 years. So probably they've already done their math. They've already done their adjustment many times. So they've got to a point where they probably have a very successful, model they're following. That's why you don't see them coming up with discounts every day, but still they are among the most profitable firms in the CFD side. They're still amongst the most consistent and reliable firms. They don't even have discounts. They don't even have affiliates. If you want to be an FTMO affiliate, you probably just sign up yourself. They don't go there trying to look for affiliates or pay you to promote our company, etc. And they're still very sustainable. So I think over time, they've still proven to be probably one of the most reliable firms, hence more expensive. Hence, they have a 10% for phase 1 and 5% for phase 2, unlike these other firms. So at the end of the day, I still love PropFirms. I've made a lot of money with PropFirms. They've made me who I am. If you've come across my channel, I think my channel has been built through PropFirm content. Most of my content, 80% of my content that has brought me a lot of audience has been PropFirm content, sharing my PropFirm journey, payouts, etc. So at the end of the day, PropFirms are still a good thing. I just have to understand that, as they are playing their game to make money, you also need to understand how you're going to position yourself. Make sure you have a strategy which has an edge. Make sure you are doing your math before you put this money in a PropFirm. In case I lose this account, can I get another account? And in case I pass this account, I also want to keep it very well, follow the rules, get consistent payouts. The best thing with PropFirms is that the risk to reward is very nice if you have an edge. Like, this is the simple PropFirm mathematics. If you have an edge, meaning primarily your strategy works and you can make money. Let's use a case study of a 100K account. Cost you roughly $500. Even if you take 400K accounts and you fail 2 to pass 2, the 2 accounts you failed only, lost you 500 times 2, which is 1,000. So you're down negative 1,000. But if you passed the other 2 accounts and each one of them just makes you 1 TP, like for me, 1 TP would be a 3R. Each one of them would make me 3,000. So times 2 would be $6,000. You do your 80% split, you still go home with 4,800. So long story short, this is a ratio of 1:4.8. If you have an edge, I'm not encouraging you to gamble to lose accounts, but I'm just telling you, if you have an edge and somehow you lose some accounts along the way because of, the conditions were bad, as long as you can still afford to get other accounts and long term you are passing more accounts and you are trading consistently, your fees to buying the account ratio to the payout will still be significant. This is a 1:4.8. You lost $1,000 to gain 4,800, something like that, if I'm not wrong. If you had to look at it from a percentage basis, it's still a very great percentage return. So at the end of the day, you can still make good money in PropFirms, more than you can make in your personal capital. But just be aware of the rules, adjust your trading style accordingly, and don't for once imagine that you can rely on a firm so much with everything. Even that FTMO, as good as it is, whichever company it is, FTMO, FundedNext, Funding Pips, whatever company is it, Fivers, just have that room for allowance that you might wake up one day and you hear they now have a consistency rule. Just have that small room for allowance that even if they allow news trading, it's possible tomorrow they may not allow it. Have that small, tiny, allowance in your head that these firms might change. So you position yourself well, you don't use your last money, and most importantly, diversify. You have a problem with this firm, you go to another firm. Like right now, I still have my accounts with FundedNext, but I am very, very much motivated to diversify across other firms, which for now I think are still more realistic. So that brings me to the end of this video. Feel free to share your thoughts about these FundedNext changes, or your thoughts overall about the prop firm space and how it's evolving. Otherwise, see you next time. Peace.